Welcome, investors. This is Kevin. This is part 2 of step-by-step oil and gas company fundamental analysis guide. In this video, I will be going through the key numbers to look at when looking at the company's financial statements. Keep in mind that financial statements are backward-looking, meaning we are looking at how the business has performed in the past, not the future. With that said, we can still use historical data to help us model the business potential for the future. Let's get started. For financial numbers, I like to categorize them into 2 categories. First is what I call the health metrics, or some other people call the balance sheet metrics. These are metrics that help us determine the odds of the company going bankrupt. And the second is the business profitability. This tells us how much cash the company receives from operating its business. For health metrics, the 3 main ones that I look at are current ratio, there's a few leverage ratios, and interest coverage ratio. The current ratio basically measures a company's ability to pay its short-term obligations, those that are due within 12 months, using its short-term assets. The formula is current assets divided by current liability. Current assets include cash, accounts receivable, and other assets expected to be converted to cash within a year. And current liabilities are accounts payable, short-term debt, accrued expenses, and other obligations due within a year. For this ratio, if the number is greater than 1, it means the company has more current assets than current liabilities. It will be considered as financially healthy. For leverage ratios, the 2 main ones to look at are net debt to free cash flow and net debt to PV10. Net debt to free cash flow ratio is a cash generating leverage ratio. It tells you exactly how many years it will take off to pay off all the debt the company owes with the money it generates from running its business. Net debt is basically total debt minus cash and cash equivalents on hand, and free cash flow is basically the money left over after covering all essential expenses. In other words, the amount of money you can take home or do whatever you want with it, assuming you own 100% of the business. In the industry, people often like to use a different cash generating leverage ratio, such as net debt to EBITDA. However, I believe net debt to EBITDA is not a good ratio to use because it does not give you a clear picture of how many years the company will take to pay off its debt. EBITDA gives you accounting earnings, not actual cash flow going into the business. The earnings are also before interest and tax. And for a company to pay off its debt, it must use money after paying off the interest and tax. Often, the differences between EBITDA and free cash flow are significant. For example, here for Rain Energy in 2024, if you do the math, EBITDA was around $230 million. For free cash flow, if you do the math here based on their numbers in the cash flow statement, the free cash flow is only $38 million. You see how big the difference is. It's almost like 200 million differences. Now coming back to net debt to free cash flow ratio. For this ratio, if it's below 1, it's what we will call fortress balance sheet. Everything from 1 to 2 is healthy and sustainable. Anything above 2 is in the over leveraged territory. Now on to net debt to PV10 leverage ratio. This is a oil and gas upstream specific ratio. It tells you how much debt the company has relative to the value of its proved reserve. In case you're not familiar with PV10, PV10 is a standard metric used by the industry for valuing oil and gas reserves. Companies usually report this value in their annual 10K SEC filings. However, if they don't, you will need to calculate it yourself. I won't be covering the details on the math for the calculation here, but if you're interested, you can do some research on this yourself. For this ratio, anything below 0.4 is great. 0.4 to 0.6 is good and sustainable, But anything above 0.6, it is getting into the overly leveraged territory. Now let's look at Ring Energies as an example. As of year-end 2024, Ring Energies net debt is around $383 million, and their PV10 here is 1.46. If you do the math, the ratio is around 0.26, which is great. Now moving on to interest coverage ratio. This ratio shows us a company's ability to pay its interest obligations. A higher number indicates greater ability to meet debt payments. For this ratio, anything above 5 is great. 3 to 5 is healthy and acceptable. If it's 2 to 3, it's in the caution zone, and anything below 2 is risky. Let's look at Ring Energies as an example. As of year-end 2024, Ring's EBIT is $133 million. As of year-end 2024, Ring's EBIT is around $133 million, and the interest expense is around $43.3 million. So if you do the math, the ratio is around 3.07. It's right on the fence between caution and healthy zone. These are the main health metrics that I look at. In volatile industry like oil and gas, a great health metric is important because 1, it helps the company survive price crashes without issuing stock or take on high interest debt. 2, it gives them the flexibility to invest and acquire assets during the downturn. These are the times where assets are being sold for like 50 cents on the dollar. And 3, it attracts investors who prioritize stability and downside protections. With that said, being in bad condition in any of these metrics does not mean that the company is hopeless. It's like a person getting a bad mark on their annual health exam. It doesn't mean they're hopeless. It simply points out the problem for us investors and the management team. If the company is willing to spend the time and effort to fix them, they will often get rewarded greatly by the market in the form of stock appreciation. Often, the reward is greater when a company that is in bad health fixes their problem over a company that is healthy and continues to run smoothly. It's like if a person who is fat suddenly goes to gym and work out for the next 6 months, you will see more improvements out of him compared to someone who has been working out their entire life and continues to go to gym for the next 6 months. Although it is always safer to invest in companies with a great health, it is by no means that you should always stay away from the one that has bad health, because they are generally the one with greater returns. As investors, all of us have different knowledge base, risk tolerance, and preferences. These metrics help us point out the risks, and it is up to us to decide whether to take the risk. Now moving on to business profitability. The most important number to look at for this is free cash flow. Again, this number shows the real cash a company generates after paying all the costs needed to run and maintain its business. The reason why I prefer looking at free cash flow as a form of earnings over the actual net income is because net incomes can easily be manipulated by non-cash items, timing differences in terms of revenue recognition, and many other accounting shenanigans. Free cash flow number will cut through all that. Thus, it's a more reliable number. Free cash flow is equal to operating cash flow minus capital expenditures. Operating cash flow is sometimes called net cash provided by operating activities, and capital expenditures might be named differently as well, such as payment to develop oil and natural gas properties, payments to purchase oil and natural gas properties. Looking at Ring Energy's 2024 10K cash flow statement, their operating cash flow is around $194 million, and their capital expenditures are around $156 million. When you do the math, their free cash flow is around $38 million. Basically, if you own 100% of Ring, you can take home $38 million in 2024. There are 2 additional risk factors associated with the company's finance that I want to talk about. The first is debt maturities, And second is production hedging. Debt maturity simply means the date when a company is required to fully repay its loan. It is important to be aware of this because if a company has a lot of debt maturing soon and it doesn't have cash flow or refinancing options, it increases the risk of bankruptcy. Here I have an example of Oxy's debt maturities as of end of 2024. Looking at this, you can see they have a lot of loans that need to be paid off or refinanced in 2026. If you're an Oxy investor, it's important for you to analyze whether they can pay off this loan before or in 2026. Now, moving on to production hedging. If you are not familiar, hedging is a risk management strategy used by companies and investors to protect against unfavorable price movements in the market. It is like insurance. You pay a cost today to reduce the chance of losing money in the future. Companies will usually tell you the amount of production hedge in their investors' presentation or SEC filings. Here I have an example from Ring Energy as of Q2 2025. For the remainder, July through December of 2025, the company has approximately 1.3 million barrels of oil, approximately 55% of their oil sales guidance, hedged at an average downside price of $64.87, and approximately 1.5 billion cubic feet of natural gas, approximately 42% of their natural gas sales guidance, hedged at an average downside price of $3.37. Downside price simply means the lowest price they will receive. In other words, 55% of oil and 42% of natural gas will be sold for at least $64.87 a barrel and $3.37 per MCF, respectively. Hedging can help companies stabilize cash flow and reduce risk if the commodity price drops. Although it mitigates downside risk, it also puts a limit on the upside potential. That concludes the part 2 of our oil and gas company fundamental analysis guide. Financial statements may be backward looking, but they give us the foundation to model the future. Although the future is not predictable with absolute certainty, using past data will help us improve our odds of success. Strong health metrics help a company survive a downturn, while free cash flow tells us whether it can create value for shareholders. Keep in mind that every one of us investors have different risk tolerance. Some prefer the safety of financially strong companies, while others chase the upsides of those fixing their balance sheet. Knowing these can help you decide where you fit on that spectrum. In the next part, I will be talking about company valuation, basically how to calculate how much the business is worth based on its fundamental. So make sure to subscribe if you haven't done so you don't miss it. Also, if you found this helpful, please give the video a like. It will really help me and supports the channel. Thank you for watching. I'll see you in the next one.